When it comes to assessing the stock market, there are two primary approaches: technical analysis and fundamental analysis. These methods differ significantly in terms of their focus and the information they consider when making investment decisions. Let's start with technical analysis. This approach relies heavily on analyzing historical price and volume data to predict future market movements. Technical analysts believe that stock price movements follow established patterns and trends that can be identified and used to forecast future price action. To conduct technical analysis, analysts use various tools and indicators, such as moving averages, trend lines, support and resistance levels, and oscillators like the Relative Strength Index, RSI, or the Moving Average Convergence Divergence, MACD. They examine stock charts, looking for recurring patterns like head and shoulders, double tops or bottoms, and triangles, among others. Technical analysts believe that all relevant information about a stock is already reflected in its price and volume data. They argue that stock prices move in trends and that these trends will continue until they show signs of reversal. By identifying these trends and patterns, technical analysts aim to make profitable trades by buying at the start of an uptrend and selling at the start of a downtrend. Fundamental analysis, on the other hand, focuses on the intrinsic value of a company and its financial health. Instead of relying on charts and patterns, fundamental analysts dig deep into a company's financial statements, economic indicators, industry trends, and competitive landscape to assess the true worth of a stock. Fundamental analysts look at a company's earnings, revenue growth, profit margins, debt levels, cash flow, and other financial metrics. They analyze the company's balance sheet, income statement, and cash flow statement to determine its overall financial health. Additionally, they consider macroeconomic factors, such as GDP growth, interest rates, and industry-specific trends, to assess the company's future prospects. The goal of fundamental analysis is to determine whether a stock is overvalued or undervalued relative to its intrinsic value. Fundamental analysts believe that the market is sometimes inefficient in pricing stocks accurately, and they seek to exploit these mispricings. If they believe a stock is undervalued, they may buy it with the expectation that the market will eventually recognize its true worth and drive the price higher. Now that we've covered the basics of technical analysis and fundamental analysis, let's talk about their respective strengths and weaknesses. Technical analysis is popular among short-term traders and those who are more focused on market timing. It can be useful for spotting short-term trading opportunities and making quick profits. However, technical analysis is often criticized for its potential subjectivity and reliance on historical patterns that may not always hold true in the future. Critics argue that technical analysis cannot account for unexpected events or fundamental shifts in a stock's value, making it less reliable for long-term investing. Fundamental analysis, on the other hand, is more commonly used by long-term investors. It provides a deeper understanding of a company's financial health and prospects, allowing investors to make more informed decisions. By focusing on the intrinsic value of a stock, fundamental analysis aims to identify companies with strong growth potential and solid financials, providing a margin of safety to investors. However, fundamental analysis can be time-consuming and requires a good grasp of financial statements and the ability to interpret economic indicators accurately. That being said, while technical analysis and fundamental analysis are often seen as opposing approaches, many successful investors use a combination of both. This approach, known as blended analysis, seeks to leverage the strengths of each method while mitigating their weaknesses. Blended analysts may use technical analysis to time their entry and exit points, taking advantage of market trends and patterns. Simultaneously, they rely on fundamental analysis to assess the long-term prospects and intrinsic value of a company. By combining these two approaches, investors aim to make more well-rounded investment decisions that consider both the short-term market dynamics and the long-term fundamentals of a stock. In conclusion, technical analysis and fundamental analysis are two distinct approaches used to assess the stock market. While technical analysis focuses on price and volume patterns to predict future price movements, fundamental analysis delves into a company's financial health and intrinsic value. Both approaches have their strengths and weaknesses, and many investors opt for a blended analysis that combines elements of both. Ultimately, the choice between technical and fundamental analysis depends on an investor's objectives, risk tolerance, and time horizon.